Real estate, land and anything permanently attached to it, including buildings, homes, and natural resources. Property, a specific piece of real estate plus the legal, intangible bundle of rights, ownership, use, and transfer attached to them. Think of real estate as the cake and property as the cake plus the recipe. Deed, legal document that transfers property ownership from seller to buyer. Think of it as the receipt that proves you own your house. Title, legal right to own a property. Having title means you have the legal authority to use, sell, or modify the property. Equity, the portion of your property that you actually own outright. If your home is worth $400,000 and you owe $250,000 on your mortgage, you have $150,000 in equity. It increases as you pay down your loan or as the property appreciates. Down payment, upfront cash. You pay when purchasing property, typically 3 to 20% of the purchase price. The bank requires this to show you have skin in the game and to reduce their lending risk. Closing, the final step in a real estate transaction where ownership officially transfers from seller to buyer. Documents are signed, money is exchanged, and keys are handed over. Escrow, neutral third party that holds money and documents during a transaction until all conditions are met. Protects both buyer and seller by ensuring everyone fulfills their obligations. Appraisal, professional estimate of a property's market value conducted by a licensed appraiser. Lenders require this to ensure they're not lending more money than the house is actually worth. Assessment, government's valuation of your property for tax purposes. This determines your property tax bill and is often lower than market value. Residential, property designed for people to live in, such as houses, condos, and apartments. Commercial, property used for business purposes like office buildings, retail stores, warehouses, and hotels. Multifamily, residential property with multiple separate living units, such as duplexes, triplexes, or apartment buildings. Allows one owner to collect rent from multiple tenants. Condominium or condo, property where you own your individual unit but share ownership of common areas like hallways, gyms, and pools with other residents. Usually comes with HOA fees. Cooperative or co-op, unlike a condo, you don't own your unit directly. Instead, you own shares in a corporation that owns the building, which gives you the right to occupy a specific unit. Common in cities like New York. Townhouse, multi-story home that shares walls with neighboring units, but typically includes ownership of the land beneath it, unlike a condo. Single-family home, standalone house on its own lot designed for one family. The most common type of residential property in America. Investment property, real estate purchased primarily to generate income or appreciate in value rather than to live in yourself. Rental property, property you own and rent out to tenants for monthly income. Seller's market or buyer's market. A seller's market means demand is high and supply is low, giving sellers the advantage with higher prices and multiple offers. A buyer's market is the opposite. More homes available than buyers, giving buyers negotiating power and lower prices. Hot market or cold market. A hot market has rapid sales, rising prices, and fierce competition. A cold market has slow sales, stagnant or falling prices, and properties sitting unsold for months. Appreciation. Increase in property value over time due to market conditions, improvements, or neighborhood development. Depreciation. Decrease in property value, though in real estate this also refers to a tax deduction for wear and tear on investment properties. Market value. What a property would actually sell for in the current market based on what buyers are willing to pay. Fair market value. The price a property would sell for between a willing buyer and willing seller, both having reasonable knowledge of the facts, with neither under pressure to complete the transaction. Comparable sales or comps. Recently sold properties similar to yours in location, size, and condition, used to determine fair market value. Mortgage. Loan specifically used to purchase real estate. The property itself serves as collateral, meaning if you don't pay, the lender can take the house through foreclosure. Pre-approval. When a lender examines your finances and confirms how much they're willing to lend you, makes you a serious buyer in competitive markets. Pre-qualification, rough estimate of how much you might be able to borrow based on self-reported financial information. Less reliable than pre-approval. Fixed rate mortgage. Mortgage where the interest rate stays the same for the entire loan term, typically 15 or 30 years. Your monthly payment remains consistent and predictable. ARM, or adjustable rate mortgage. Mortgage, where the interest rate can change periodically based on market conditions, usually starts with a lower rate than fixed mortgages but carries risk of increases. Interest rate, percentage charged by the lender for borrowing money. A lower rate means lower monthly payments and less paid over the life of the loan. APR, or annual percentage rate, the true cost of borrowing, including interest rate plus fees and other charges, always higher than the advertised interest rate and better for comparing loan offers. Points, fees paid to the lender at closing to reduce your interest rate. 1 point equals 1% of the loan amount. Paying points makes sense if you plan to keep the mortgage long term. Principal, the actual amount of money you borrowed, not including interest. Each mortgage payment includes both principal and interest. Amortization, the process of paying off a loan through regular payments over time. Early payments are mostly interest. Later payments are mostly principal. PMI/private mortgage insurance. Insurance you must pay if your down payment is less than 20%. Protects the lender if you default, but adds to your monthly cost. Goes away once you reach 20% equity. Refinancing, replacing your current mortgage with a new one, usually to get a lower interest rate, change loan terms, or pull cash out from your equity. LTV, or loan-to-value ratio, percentage of the property's value that you're borrowing. A $200,000 loan on a $250,000 house is an 80% LTV. Lower LTV means less risk for lenders. DTI/debt-to-income ratio, your monthly debt payments divided by your gross monthly income. Lenders use this to determine if you can afford the mortgage. Most want DTI below 43%. Listing, property officially put up for sale, usually through a real estate agent who markets it. MLS/multiple listing service, database where real estate agents share property listings, gives properties maximum exposure to potential buyers and their agents. Offer, formal proposal to purchase a property at a specific price with specific terms. Can be accepted, rejected, or countered. Counteroffer, when a seller responds to a buyer's offer with different terms, usually a different price. Begins a negotiation process. Contingency, condition that must be met for the sale to go through. Common contingencies include financing, inspection, and appraisal. If contingencies aren't met, you can back out without losing your deposit. Inspection, professional examination of a property's condition, checking for structural issues, electrical problems, plumbing defects, and more. Almost always recommended before purchasing. Due diligence, period after an offer is accepted where the buyer investigates the property through inspections, title searches, and reviewing documents to ensure there are no surprises. Earnest money, deposit you give when making an offer to show you're serious. Typically 1 to 3% of the purchase price. If the deal goes through, it counts toward your down payment. If you back out for no valid reason, the seller keeps it. Closing costs, all the fees you pay when finalizing the purchase beyond the down payment. Includes lender fees, title insurance, attorney fees, recording fees, and more. Typically 2 to 5% of the purchase price. Prorated, expenses like property taxes or HOA fees divided proportionally between buyer and seller based on closing date. If you close mid-month, you only pay for the days you own the property. Settlement statement, document showing all money exchanged in the transaction. Every fee, every credit, every dollar accounted for, required by law and reviewed at closing. Walkthrough, final inspection of the property, usually done 24 hours before closing, to ensure agreed upon repairs were made and the property is in expected condition. Foreclosure, legal process where a lender takes possession of a property because the borrower failed to make mortgage payments. The lender then sells the property to recover the money owed. Short sale, when a homeowner sells their property for less than what they owe on the mortgage, with the lender's approval. Usually happens when the owner is in financial distress but wants to avoid foreclosure. Lien, legal claim against a property by someone who is owed money, must be paid off before the property can be sold. Common types include tax liens, mechanics liens, and judgment liens. Encumbrance, anything that affects or limits the ownership rights of a property, such as liens, easements, or deed restrictions. Easement, legal right for someone to use a portion of your property for a specific purpose, like utility companies accessing power lines or a neighbor using a shared driveway. Zoning, government regulations that control how property can be used in specific areas. Determines whether you can run a business from home, build additions, or convert residential to commercial. HOA, Homeowners Association, organization in planned communities that enforces rules and maintains common areas. Charges monthly or annual fees and can fine homeowners for violations. Clear title, property ownership, free from liens, disputes, or legal questions. What you want when buying a home. Chain of title. Complete history of property ownership transfers from the original owner to the present. Examined during title search to ensure there are no gaps or problems. Title insurance. Insurance protecting buyers and lenders from financial loss due to title defects discovered after purchase. Owner's policy protects you. Lender's policy protects the bank. Cash flow. Money left over each month after all property expenses are paid. If you rent a property for $2,000 but mortgage, taxes, insurance and maintenance cost $1,600, your cash flow is $400. Positive cash flow means profit, negative means loss. Cap rate or capitalization rate measures the return on an investment property by dividing the property's annual net income by its purchase price. A 7% cap rate is generally considered good but varies by market. ROI, return on investment, total profit or loss on an investment relative to its cost. Includes cash flow, appreciation, tax benefits, and equity buildup. Flipping, buying a property, renovating it quickly, and selling it for profit. Requires significant capital, construction knowledge, and good timing, or you can lose big. BRRRR, buy, rehab, rent, refinance, repeat. Investment strategy, where you buy a distressed property, fix it up, rent it out, refinance to pull your initial investment back out, then repeat with another property. 1031 exchange. IRS rule, allowing real estate investors to defer capital gains taxes by selling one investment property and buying another like kind. Property within specific timeframes. Must follow strict rules. Wholesale C wholesaling, finding discounted properties, getting them under contract, then selling that contract to another buyer for a fee. You never actually own the property. Rent to own, agreement where a tenant rents a property with the option to purchase it later, with part of their rent potentially credited toward the purchase price. Subject to buying a property while leaving the existing mortgage in the seller's name. You take over payments but don't officially assume the loan. Risky for both parties. Pocket listing. Property for sale that isn't listed on the MLS. Sold quietly through agent networks, often for privacy or exclusivity. Bidding war. When multiple buyers compete for the same property by making increasingly higher offers. Common in hot markets and often leads to paying above asking price. Gazumping, when a seller accepts your offer but then accepts a higher offer from someone else before contracts are signed. More common in the UK, less protected against in the US than you'd think. As is property sold in its current condition with no repairs or improvements from the seller. This doesn't mean you can't inspect it, but the seller won't fix anything you find. Turnkey, property in excellent condition that requires no repairs or renovations. You can literally turn the key and move in or start renting immediately. Fixer-upper, property needing significant repairs or renovations. Usually sold at a discount but requires construction knowledge and budget to improve. FSBO or for sale, by owner. When a homeowner sells their property without using a real estate agent. Saves commission, but requires the seller to handle all marketing, negotiations, and paperwork. Under contract. Property, where a buyer's offer has been accepted and a purchase agreement signed, but the sale hasn't closed yet, usually not available to other buyers during this period. Pending, similar to under contract. The sale is in process, contingencies are being worked through, and closing is approaching.